If you'd had your money in gold instead of stocks over the last year, you would have done significantly better. Now, personally, I like to look at longer periods of time. So if you had looked at the last 10 years, you actually would have had a positive return with gold over this time period as compared to basically a flat return with stocks. So on a monthly basis, over the last 10 years, so you're talking 120 months, gold did significantly better than stocks.
Dr. William Chittenden, professor and chair of the Department of Finance and Economics at Texas State University, is one of the many experts who advocate diversifying with gold as a way of protecting your money.
Gold specifically is attractive from a diversification perspective because it has what we call negative correlation with stock and bond returns. So when the stock market's doing very well, gold doesn't tend to do as well. However, particularly over the last couple of years where stocks have done relatively poorly, gold has done extremely well. And so you have that balancing effect. And gold is a good counterweight to many of the other assets that you'll typically have in your portfolio.
As the Federal Reserve continues to pump freshly printed money into the anemic financial system, the chances may have substantially increased that gold will outperform the dollar over the long haul. If the massive cash injections into the economy do prove inflationary, as many analysts predict, gold's upside potential could be enormous. The U.S. dollar has lost approximately 25% of its purchasing power since 2003, while gold has tripled in value in the same amount of time.
Well, gold's a nice advantage compared to cash, as we talked about earlier, in that gold's a good hedge against inflation. So everything else the same, if we start to see inflation, gold prices are likely going to increase right along with that rate of inflation, as compared to cash, which is going to lose its value as we see increases in inflation. So although you might have a zero, what we'd call nominal return if you held cash, you're actually losing purchasing power. Because of inflation, those same dollars that you have today are going to buy less a year from now. But if gold is keeping up with that pace of inflation, then at a minimum, your purchasing power is staying the same. If the Fed decides to back off and slowly start unwinding or reducing some of this money's outstanding, we're going to be okay. On the other hand, if they continue to increase the amount of money that's out there, then one of the big potential problems is massive inflation. Well, if we start to see massive inflation, gold has historically been a very good hedge against inflation. In high inflationary periods, gold has done extremely well.
When protecting your wealth, diversifying your portfolio with only mutual funds, bonds, and different stocks is not enough. You're still putting your money into paper assets. This is why many experts recommend owning physical gold as a way of preserving your wealth. Remember, the Dow Jones recently lost more than 5,000 points in less than 1 year. Gold, however, not only retained its value, but actually increased by 17% in the same amount of time. Gold is different than paper. When you physically own the precious metal, you take possession of the asset, an asset that has strong liquidity, while retaining the quality of real value. And remember, unlike paper assets, gold has never, ever been at zero.